I've spent decades watching people work themselves to exhaustion, earn decent salaries, and somehow end up with nothing to show for it. Meanwhile, others earning far less build substantial wealth that compounds year after year. The difference isn't luck. It isn't about who works harder or who deserves it more. The difference is mathematical, and most people never learn the equation. When I started as a math professor at MIT and Harvard, my salary was modest by today's standards. Yet, I understood something fundamental that most people miss entirely. Wealth isn't about how much you earn. It's about the rate at which you convert income into assets that generate returns. That's not motivational talk. That's mathematics. And if you don't understand the math, you'll spend your entire life working for money instead of having money work for you. Here's what I've observed over 50 years of studying markets, building algorithms, and watching human behavior. Most people treat their salary as a consumption budget. They calculate what they can afford to spend based on what they earn. This is the first and most devastating mistake. They're solving for the wrong variable. They're optimizing for lifestyle when they should be optimizing for the rate of capital accumulation. The moment your paycheck hits your account, you're already making a choice. Either that money becomes an asset that grows, or it becomes an expense that disappears. There's no middle ground, despite what people tell themselves. Let me be direct about something uncomfortable. The traditional financial advice you've heard your entire life is designed to keep you comfortable, not to make you wealthy. Save 10% of your income. Build an emergency fund. Contribute to your retirement account. This advice isn't wrong, but it's incomplete and it's slow. It's advice designed for people who want to retire at 65 with enough money to not be a burden. That's not wealth. That's just avoiding poverty in old age. If you want actual wealth on a small salary, you need to think like a mathematician, not like someone following a personal finance checklist. The core problem is that most people operate on linear thinking in an exponential world. They think about money in terms of addition and subtraction. I earn this amount. I spend that amount. I save the difference. But wealth is built through multiplication and exponents. It's built through compounding returns over time. The equation isn't income minus expenses equals savings. The equation is principal times rate raised to the power of time. When you understand that distinction, everything changes. I want to walk you through exactly how someone on a Monticello can build genuine wealth. Not get-rich-quick schemes. Not crypto gambling or day trading. I'm talking about applying mathematical principles that have created more wealth than any other method in human history. These are the same principles I used to build Renaissance technologies, and they work at any income level because mathematics doesn't care how much you earn. It only cares about the variables you control. Let's start with the first principle that changes everything. I call it solving for the right variable. When most people get a raise or a bonus, they immediately calculate what they can now afford. A nicer apartment, a better car. They've just increased their income, and they respond by increasing their expenses proportionally. This is mathematically insane. What they've actually done is kept their savings rate constant, or even decreased it while giving themselves more work stress and lifestyle obligations. They've optimized for the wrong outcome. Here's what I learned early in my career. When my salary increased, I treated it as though it hadn't. I maintained the same lifestyle I had been living on the previous salary and directed 100% of the increase toward investments. Not 90%, not 50%, 100%. The mathematical impact of this approach is staggering. If you're earning $50,000 living on $40,000, you're saving $10,000 per year. That's a 20% savings rate. Now you get a raise to $60,000. Most people start living on $50,000 and save the same $10,000. Their savings rate just dropped to about 17%. But if you continue living on $40,000 and save $20,000, your savings rate just jumped to 33%. You've more than doubled your rate of capital accumulation without changing your lifestyle at all. This requires something most people can't do, which is emotional discipline. You have to genuinely not care what other people think about how you live. I drove an old car for years after I could afford a new one. I lived in the same modest house. People who didn't understand mathematics thought I was cheap or that I didn't know how to enjoy life. People who understood mathematics knew I was solving a different equation. I wasn't maximizing present consumption. I was maximizing the future value of my capital at the highest possible rate. Let me give you a concrete example of how this plays out over time. Imagine two people both earning $50,000 per year. Person A saves 10% or $5,000 per year. Person B lives far below their means and saves 30%, $15,000 per year. They both invest in a simple index fund returning 8% annually, which is roughly the historical average. After 10 years, person A has about $78,000, Hodgson's about $234,000. Person B has 3 times the wealth despite earning the same salary. After 20 years, person A has about $250,000. Person B has over $1 million. Same job, same salary, same investment strategy. The only difference is the savings rate. But here's where it gets interesting. After 20 years, person B's investments are now generating about $80,000 per year in returns at 8%. That's more than their original salary, and they haven't touched the principal. Person B is now financially independent, while person A still depends entirely on their paycheck. Person B reached this point not through luck or a high-paying job, but through understanding a simple mathematical principle. The rate at which you convert income to assets determines your timeline to financial independence far more than your absolute income level. Now, let's talk about the second principle that most people completely misunderstand. Risk is not what you think it is. When I talk to people about investing their savings, they immediately start talking about risk. They say they can't afford to lose money, so they keep it in savings accounts earning 1% while inflation runs at 3%. They think they're being safe. In reality, they're guaranteeing a loss. They're losing 2% of their purchasing power every single year with absolute certainty. That's not safety. That's mathematical erosion. Real risk is the probability of permanent loss of capital. It's not volatility. It's not your investment going down 20% in a bad year. It's the chance that you put money into something and it never comes back. When you invest in a diversified portfolio of productive assets, businesses that make real products and generate real profits, the long-term risk of permanent loss approaches zero over a sufficient time horizon. Over any 20-year period in history, diversified equity markets have never produced a negative return. Never. The risk is not in investing. The risk is in not investing and guaranteeing that inflation erodes your purchasing power. People confuse volatility with risk because volatility is emotionally uncomfortable. They check their account, see it's down 15% and panic. This is where most people destroy their own returns. They sell low because they can't tolerate the emotional discomfort of watching numbers fluctuate. Then they buy back in after it's recovered and they feel safe again, which means buying high. They've just locked in losses through their own emotional reaction to normal market behavior. I learned something crucial when I transitioned from academia to finance. Markets are noisy, incredibly noisy. If you measure returns over a day, a week, or a month, the signal-to-noise ratio is terrible. You're mostly seeing random fluctuation. But if you measure over years and decades, the noise averages out and the signal becomes clear. Productive assets generate returns over time. This is one of the most reliable patterns in all of economics. But you only benefit from this pattern if you can tolerate short-term volatility without making emotional decisions. Here's what this means practically. If you're in your 20s, 30s, or 40s, and you're investing for retirement or long-term wealth, 100% of your invested capital should be in equities, not bonds, not cash equities. People will tell you that's too risky. Those people don't understand mathematics. The risk of being too conservative is far greater than the risk of short-term volatility when you have decades ahead of you. Every year you spend in low-return assets is a year of compounding you'll never get back. That's the real risk. Let me tell you about a pattern I noticed early in my career. The people who built the most wealth weren't the ones who were the smartest about timing the market. They weren't the ones who found the best stocks or made brilliant trades. They were the ones who started investing early, invested consistently regardless of market conditions, and never stopped. They were the ones who understood that timing the market beats timing the market every single time. This isn't motivational thinking. This is mathematical fact. The compound annual return of the stock market over the past century is about 10%, but the average investor's return is closer to 4%. Why the gap? Because people get scared and sell at the bottom. They get excited and buy at the top. They trade frequently and rack up fees. They destroy their own returns through activity. The third principle is about information and decision making. In my work building trading algorithms, I learned that more information is often worse than less information if you don't know how to process it properly. Most people drown themselves in financial news, stock tips, market predictions, and expert opinions. All of this is noise. Worse than noise, actually, because it triggers emotional reactions that lead to bad decisions. Here's what you actually need to know if you're building wealth on a salary. What's your savings rate? What percentage of your income are you converting to assets? What are your investments? For most people, this should be simple index funds that track the entire market. What's your time horizon? How many years until you need this money? That's it. Those three questions determine your financial outcome far more than anything you'll read in the financial news. I've watched brilliant people with advanced degrees destroy their wealth by trying to be clever. They read an article about some hot stock or emerging trend, and they decide to be active investors. They start trading. They start trying to time the market. They convince themselves they can beat the professionals who do this 80 hours a week with teams of analysts and sophisticated algorithms. This is pure hubris, and it's expensive. Every trade has costs. Every active decision is an opportunity to be wrong. The mathematics of active investing are brutal. To beat the market after fees and taxes, you need to be right. Not just more often than you're wrong, but significantly more often. Most professionals can't do this consistently. Individual investors certainly can't. The intelligent approach is boring. Invest in low-cost index funds that own everything. Contribute consistently regardless of market conditions. Rebalance once a year. Ignore everything else. This approach requires no special knowledge, no market timing, no stock picking. It just requires discipline and patience. Those are psychological traits, not financial skills. Yet most people lack them. Let me share something I observed repeatedly throughout my career. The people who failed financially almost always failed because of psychological factors, not because they lacked information or intelligence. They failed because they were impatient. They failed because they compared themselves to others and made consumption decisions based on status rather than mathematics. They failed because they couldn't tolerate temporary discomfort for long-term gain. They failed because they were emotional about money instead of rational. I built Renaissance technologies on the principle that emotions have no place in investment decisions. Every decision was made by algorithms based on data and mathematical models. Human intuition, human fear, human greed. These were eliminated from the process entirely. You can't build an algorithm to manage your personal finances, but you can build a system that removes emotion from your decisions. Automatic contributions to investment accounts, automatic rebalancing, rules you follow regardless of how you feel. The system makes decisions, not your emotions. Here's the fourth principle, and this one makes people uncomfortable. Your human capital is your largest asset, and most people completely mismanage it. When you're young, the present value of all your future earnings is enormous. If you're 25 and you'll work for 40 more years earning an average of 60,000 per year, that's 4 million. That's your human capital. It's an asset. And like any asset, it can grow or depreciate based on how you manage it. Most people treat their career like a static thing. They get a job, they do the work, they get modest raises. They never invest in increasing the value of their human capital. This is insane. A 10% increase in your lifetime earnings is worth far more than a 10% return on your investments when you're young, because the base amount is so much larger. If you're earning $50,000 and you have $10,000 invested, a 10% return gives you $1,000, but a 10% increase in your salary gives you $5, $1,000 per year every year for the rest of your career. I spent years investing in my own knowledge and skills. I learned cryptography, which led to consulting opportunities. I transitioned from pure mathematics to applied finance. Each skill I developed increased my earning potential. But more importantly, I was strategic about it. I didn't just learn random things. I learned skills that were valuable and rare. Skills that put me in the intersection of multiple fields where there was less competition. This is how you increase human capital efficiently. For someone earning a modest salary, investing in yourself has to be the highest priority. Not material possessions, not entertainment, not lifestyle, inflation, skills, knowledge, credentials, relationships. These things increase your earning potential, which increases your savings potential, which accelerates your timeline to wealth. A single career change that increases your salary by $20,000 is worth more than years of investment returns when you're starting out. Yet, people spend more time researching which stocks to buy than researching how to increase their human capital. There's also a mathematical concept here that most people miss. Your early career years are the highest value time of your life in terms of building wealth, because you have the most years of compounding ahead of you. Every dollar you invest at 25 has 40 years to compound if you retire at 65. At an 8% return, that dollar becomes about 21. Every dollar you invest at 45 only has 20 years. So it becomes about 4. The same dollar invested early is worth 5 times more than the same dollar invested late. This is why aggressive saving and investing in your 20s and 30s is so crucial. You have time, which is the most valuable variable in the compounding equation. The fifth principle is about systems versus goals. I learned this building trading models. You don't optimize for a specific target. You optimize for a process that generates consistent positive returns over time. People set goals like, I want to save 100,000 or I want to be a millionaire by 40. These goals are fine for motivation, but they're useless for action. What matters is the system. What's your automatic savings rate? What's your investment process? What's your plan for increasing income? The system is what you do every day, every month, every year. The goal is just what you hope the system produces. If your system is sound, the goals take care of themselves. If your system is broken, no amount of goal setting will help. I see people set ambitious financial goals all the time. They're going to save more. They're going to invest better. They're going to change their habits. Then nothing changes because they never built a system. They relied on motivation and willpower, which are finite resources. Systems don't require motivation. They just run. Automatic contributions from your paycheck. Automatic investment into index funds. Automatic increases in contribution percentage whenever you get a raise. The system runs whether you're motivated or not. Let me tell you what wealth actually looks like when you build it this way. It doesn't look exciting. You won't have dramatic stories about the stock you picked that went up 10 times or the crypto you bought at the perfect moment. You'll have a spreadsheet that shows steady, consistent growth over decades. Your net worth will increase every year. Your investments will compound eventually, and this is the moment that changes everything. Your investment returns will exceed your salary. You'll realize you could stop working and your wealth would continue growing. That's financial independence, and it's available to anyone who understands the mathematics and has the discipline to execute consistently. Most people never reach this point, not because they can't, but because they won't. They won't live below their means. They won't invest aggressively. They won't maintain discipline over decades. They want wealth, but they're unwilling to do what wealth requires. They want the outcome without the process. This doesn't work. Wealth is a mathematical consequence of specific behaviors maintained over time. If you execute the behaviors, you get the outcome. If you don't, you won't. It's that simple. Here's something that might surprise you. I've known people who earned $200,000 per year and built no wealth. I've known people who earned $50,000 per year and became millionaires. The difference was never the income. It was always the savings rate, the investment strategy, and the time horizon. The person earning $50,000 who saves 30% and invests it properly will build more wealth than the person earning $200,000 who saves 5%. This is mathematical fact, not opinion. So let's talk about what you actually do with this information. First, calculate your current savings rate. Take your annual savings and divide by your annual income. If that number is below 20%, you have a problem. Your timeline to financial independence is too long. You need to either increase income or decrease expenses, preferably both. This isn't about deprivation, it's about priorities. You're choosing between present consumption and future freedom. Most people choose present consumption because it's immediate and tangible. Future freedom is abstract. This is a psychological failing, not a mathematical one. Second, automate everything. Set up automatic transfers from your checking account to your investment account the day after your paycheck hits. Not at the end of the month after you've paid for everything else. First, pay your future self first, then live on what's left. This flips the traditional budgeting model on its head. Most people save what's left after spending. Wealthy people spend what's left after saving. Same income, opposite approach, completely different outcome. Third, invest in the simplest, lowest cost index funds you can find, total market funds. Set it and forget it. Don't check it daily. Don't react to market movements. Don't try to be clever, just consistent. Every month, the same amount goes in regardless of whether the market is up or down. This is called dollar cost averaging, and it's one of the few free lunches in investing. When the market is down, you're buying more shares for the same money. When it's up, your existing shares are worth more. Over time, this smooths out volatility and maximizes returns. Fourth, invest aggressively in your human capital early. Take courses. Get certifications. Learn skills that are valuable and rare. Network strategically. Position yourself in fields where compensation is high and growing. Every $1,000 you invest in increasing your income potential by 5 or 10,000 per year is the highest return investment you'll ever make. Fifth, ignore everyone who tells you to enjoy your money while you're young. This is terrible advice disguised as wisdom. The people who say this usually haven't built wealth themselves. They're justifying their own consumption decisions by encouraging you to make the same mistakes. You can enjoy your life without spending money you should be investing. Enjoyment and consumption are not the same thing. I had a fulfilling life as a professor earning a modest salary because fulfillment comes from meaningful work and relationships, not from possessions and lifestyle. Let me address something directly. Some of you are thinking this sounds miserable. You're thinking, what's the point of earning money if I can't spend it? This reaction tells me you're still thinking about money wrong. Money isn't for spending. Money is for buying freedom. Every dollar you invest is buying you future time. Time where you don't have to work. Time where you can do what you want instead of what you must. That's what wealth is. It's not possessions, it's options. It's the ability to say no to things you don't want to do. When I reached the point where my investments generated more than my expenses, everything changed. Not because I started spending more. I didn't, but because I had complete freedom over my time. I could work on problems I found interesting. I could take risks without worrying about the financial outcome. I could think long-term because I didn't need short-term results. That's what you're building toward. Not a fancy car or a big house. Those things are traps. They lock you into needing to maintain high income to support high expenses. That's not wealth. That's a prison with nice furniture. Real wealth is having your investment returns cover your lifestyle expenses with room to spare. At that point, work becomes optional. Not because you're retired, but because you're free. You can still work. Most wealthy people do because meaningful work is satisfying. But you work because you choose to, not because you have to. That distinction is everything. Let me be clear about the timeline because people always ask how long does this take? The mathematics are straightforward. If you save 20% of your income and invest it at 8% returns, you reach financial independence in about 37 years. If you save 30%, it takes 28 years. If you save 50%, it takes 17 years. If you save 70%, it takes 12 years. See the pattern? The savings rate dominates the equation. It matters far more than your investment returns or your income level. This means a 30-year-old earning $58,000 who saves 50% and invested properly can reach financial independence by 47. They'll have enough invested that the returns cover their expenses. Meanwhile, a 30-year-old earning $150,000 who only saves 10% will still be decades away from independence despite earning 3 times as much. The math doesn't lie. Savings rate is everything. Now, here's what I want you to understand about why most people fail at this. It's not because they don't know what to do. Everything I've told you is simple. It's not secret knowledge. It's basic mathematics and common sense. People fail because they can't control their psychology. They compare themselves to others. They care about status. They need validation through consumption. They're impatient. They want results. Now, these are all emotional problems, not knowledge problems. The people who build wealth have one thing in common, regardless of income level. They have emotional control. They can delay gratification. They can maintain discipline over decades. They don't need external validation. They optimize for long-term outcomes over short-term comfort. These are not natural human traits. Our brains evolved for immediate survival, not for long-term wealth building. You have to consciously override your instincts. You have to be rational when your emotions want you to be reactive. This is hard. It's why most people never do it. But here's the encouraging part. It's a skill you can develop. Emotional discipline around money is like physical discipline around exercise. At first, it's difficult. It requires conscious effort. But over time, it becomes habit. The automatic contributions become normal. Living below your means becomes your default. Not reacting to market volatility becomes easy because you've done it enough times to know it always recovers. The discipline that felt like sacrifice early on becomes just how you operate. I want to leave you with this. I've watched thousands of people make financial decisions over decades. I've seen who builds wealth and who doesn't. The variable that predicts outcomes better than any other is time preference. People with low time preference, meaning they prefer larger rewards later over smaller rewards now, build wealth. People with high time preference, meaning they prefer immediate gratification, don't. It's that simple. Everything else, income, intelligence, education, background, these matter far less than whether you can consistently choose your future self over your present self. Wealth on a small salary is absolutely possible. It's not even particularly complicated. It just requires understanding the mathematics and having the discipline to execute consistently over a long period. Most people know what to do, they just won't do it. Don't be most people. Before we finish, I need something from you. If this video gave you a new way of thinking about wealth and salary, hit the like button. More importantly, leave a comment with one specific action you're going to take in the next week based on what you learned here. Not a vague intention, a specific action. I'll automate an extra 100 per month into investments. I'll calculate my current savings rate. I'll research low-cost index funds. Something concrete. Writing it down increases the probability you'll actually do it. That's not motivation. That's psychology. Let me summarize what we covered because these principles are too important to forget. First, solve for the right variable. Optimize for savings rate, not lifestyle. Every raise should increase your investment contributions, not your expenses. Second, understand that real risk is not investing, not volatility. Time in the market beats timing the market. Emotional discipline beats clever strategy. Third, eliminate noise from your decision-making. Automate your system and ignore daily market movements. Fourth, your human capital is your largest asset when you're young. Invest in skills that increase your earning potential. Fifth, build systems, not goals. The daily process matters more than the distant target. These principles work regardless of your income level because they're based on mathematics, not luck. They worked when I was a professor earning a modest salary. They worked as I built Renaissance. They'll work for you if you have the discipline to execute them consistently. Wealth isn't about how much you earn. It's about how much you keep, how intelligently you invest it, and how long you let it compound. Control those variables, and the outcome is inevitable. That's how you build wealth on a small salary, not through luck or timing or finding the next big thing. Through understanding the mathematics of compounding, controlling your psychology, and maintaining discipline over decades. It's simple. It's not easy, but it's absolutely possible for anyone willing to think rationally instead of emotionally. Now go execute.